Hello and welcome to my third and final video installment in my series, How to Not Get Mauled by a Bear Market. I'm Joe Davis, president of Stonebriar Wealth Management. In this video, I'd like to provide actionable tips to help you cope with market volatility.
Stonebriar Wealth Management, advisors for your life.
Surviving a bear market comes down to fortitude in all aspects of your investment acumen. My first bit of advice: turn off CNBC. We aren't picking on CNBC for the sake of its content, but the mainstream financial media in general are not in the business of making you money. They are in the business of selling advertising by gaining the most eyeballs on their product as possible. That often involves cultivating a narrative of fear or embellishing certain data points to imply that things are only going to get worse. Furthermore, very few commentators on financial news networks are managing real money for real clients. Those that do misconstrue their advice on TV to appear more impactful than it really is. For example, we've all witnessed a strategist say, "We're selling stocks here because we think the market is headed much lower." It sounds like they've gone 100% into cash all at once, but the reality is they probably sold 1 to 3% of their allocation just to reposition elsewhere. And second, avoid the temptation to time the market. Portfolio changes should be predicated on evidence-based factors rather than the whims of psychology or feel. Define the circumstances that will lead to further changes in your portfolio so you know when and why you will be making a strategic change within your portfolio. That may include a game plan with your advisor for putting excess cash to work on the sidelines, for shifting capital among asset classes such as bonds, commodities, and stocks. Number 3, utilize the sell-off to your advantage. I once heard the phrase that the stock market is the only shop in the world where things go on sale and everyone runs out of the store. I'm sure you can agree with that comparison after living through these cycles in the past. One of the best ways to mitigate the impact of a bear market and continually create consistent positive action is by utilizing the price declines to your advantage. Number 4, create a game plan with your advisor for putting money to work as the sell-off develops. Maybe it is designing a plan to buy $500 of an ETF each month, so you are either establishing a new position at attractive prices or lower your cost basis on an existing holding. Number 5, this is for younger clients still in the wealth accumulation phase, as you should prioritize increasing contributions to your 401ks, IRAs, and other retirement plans. Being able to consistently put money to work at lower prices will ultimately benefit you in the long run. Furthermore, if you can take advantage of an elevated company match or profit sharing, then you will face increased compounding efforts exponentially in your portfolio. It's counterintuitive for most people to put more money to work when the market is falling. Most want to take their foot off the gas and prioritize safety over potential short-term losses. However, the process of dollar cost averaging and how it benefits your financial plan is one of the best approaches in times of volatility. Number 6, overcoming the age objection. It's easier to calm your fears when younger and are still in the wealth accumulation phase of your life. The fact that you are actively contributing to your nest egg from current earnings helps overcome the impact of the decline. However, these bear markets can be far scarier for clients or individuals that are older or in the sunset years of their life. You might feel that you can't afford to lose any money as you watch account values suffer temporarily and will want to make immediate changes to stop the bleeding. It's important to remember that you have already lived and prospered through countless bear markets over the entire lifetime. You might even have made mistakes in the past and regret not staying the course. This time should be no different, and making drastic changes in the name of protecting capital could ultimately cost you significant growth opportunities that are needed to achieve your retirement goals. Number 7, think in percentages, not dollars. Tell me if you've said this or felt this. I just looked at my statement and we lost $100,000 last month. While that may technically be true, it's important to remember that this could just be a small percentage of your overall net worth. It's far more productive and less emotive to talk about that $100,000 being, say, a 10% drop, and to put it in the perspective of the broader market. It's immediately soothing to understand that your multi-asset portfolio was only down 10% when the S&P 500 fell 15% or the NASDAQ 20% over that same time frame. So in conclusion, each bear market is going to travel a unique path of price discovery, time frames, and narratives that will leave a distinguished mark on history. However, what remains the same throughout each cycle is how investors process and react to the discomfort. Stability and resolute consistency during these disruptive periods will help you navigate a bear market's temporary wrath. The power of patience will ultimately prevail. In this message, again, for myself, Joe Davis, and I'd like to thank you for all that you've done in watching these videos, and I hope that we can stay in touch by you subscribing or reaching out through my website or on social media. Thank you.
Stone Briar Wealth Management, advisors for your life.
This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process described herein will be profitable. Investors may lose all of their investments. Past performance is not indicative of current or future performance. It is not a guarantee.